Hi, this is Randy Finney with Right Side of the Chart, and this is a late morning session update for Monday, March 9th, 2020. It's actually started out as an early morning update. I just wrapped up a video a little while ago, but there was so much, and I kind of threw in a lot that it's just too long. I'm trying to keep these. I know you guys are busy. The markets are moving. I want to get these out, so I'm going to just redo this video and keep it a lot shorter until you kind of hit on the salient points here. All right, so first, we'll start out with QQQ, since that's where where we're trying to game this recent correction. It's our official trade proxy on the market right here, QQQ. We shorted that just a couple trading sessions, few trading sessions back around 212.57. And this morning I put out an update, which you probably got by now, that decided to hold off. Change the stop instead of cashing out and closing that trade out here at the first target that would have been hit this morning. And I always say this: suggested targets, suggested stops. Even the trades themselves are just that, suggestions. Take the ones you like, pass on the ones you don't, the ones that don't mesh with your trading style, and then of course use your own targets, stops, whatever meshes with your trading style and your comfort level. So that one again would have been hit, but what I'm doing here is decided to hold out and see if we can let this morph into a potential trend trade or longer term swing trade with higher targets. So what I did is lower the stop strategically down from where we had it. We were at 218.50, which was up here. We entered around 212.57 or so, and 218.50. This line up here was the stop before. And what I did is set it above the comfortably, what I believe to be comfortably above the 200-day exponential moving average. So to kind of recap what's happened today. And I'll get to the bounce that we've had so far, and we'll get to the 60-minute charts and some developments to look for. But bigger picture is this. We had highlighted in recent weeks and over the years many times what I believe to be the importance of the 200-day moving averages. You have both the exponential moving average in red here, and you have the 200-day simple moving average in blue. Some traders use one, some use the other. And for that very reason, I like to keep them both on my chart. I have a preference towards the 200-day exponential moving average most of the time. But again, to me, it's not important which one I like or which one I think is better. Which one are the majority of market participants looking at and trading off of? And if they're using both, then why not put both up on here and give the benefit of the doubt to the latter of the two to break? And so you can see they both come in roughly together, and they do a good job. And you can roll back for years. I'm not going to do it here. It does a good job of defining uptrends, bullish when the market's above the 200-day, and bearish when the market's below, like that. And then, of course, these moving averages act as support and on pullbacks and resistance on kickbacks during downtrends. So support, little intraday, one-day break, snap right back above it after that. And just the other day, kind of fast forward, and I mentioned this before, we hit the 200-day simple moving average almost to the button in reverse there. And same day we went through the 200 exponential moving average on an intraday basis, but then closed back above it. So both of those are successful tests because this is a daily chart. All that matters is your daily close. It's perfectly normal. In fact, it is perfectly acceptable, I should say, but also perfectly normal to see an overshoot of a resistance level when you have a waterfall type sell-off like we did. I call that a momentum field overshoot. So anyways, the other thing I often say, and one of the reasons I'll list multiple price targets on many of my trades is those targets are set at support or resistance levels where I expect a reaction on the initial tag from above or below. So what does that mean? So we hadn't visited the 200-day. Last time we touched the 200-day EMA was back here in October of last year. And so this was the initial tag, and like I said that day, and that's why we went long. We gamed a long trade. We went official long after closing out a short right before that. We were short on the way down, long that day at the lows on Friday the 28th, closed that long out on the bounce when the target was hit, and then we reversed back to a short. That's swing trading for you guys. The trend trading is being short here, capturing down, and that's the potential I'm allowing for this trade now to maybe morph into a trend trade or a longer term swing trade. All right, so back to the point there is The 200 days were tested once. That's the initial reaction. And therefore, that leaves the door open if they're going to break on the next tag or one of the subsequent tags. So what happened today, to keep things very simple right now, the risk oversimplifying, we gapped down and took out the 200-day EMA and the 200-day SMA in one fell swoop with today's gap down. So there's a gap below support, and TA 101 says support once broken becomes resistance. It's that simple. Doesn't mean that resistance cannot be regained, but so far that's what's checked the capped today's rally. The day is still young. I'm going to get to some levels now, and if it pops above the can take out this 200-day SMA right here, then you have the 200-day EMA and the top of the gap somewhat above. So here's your big resistance level. As impressive as the intraday recovery has been, I'll tell you what that is right now. The intraday recovery off the lows on QQQ has so far, from low to high, been about almost 4%. So if you're of the mindset, oh my gosh, that means nothing but bullish, how can that not be taken as bullish? They're stepping in, buying the market. Everything's relative. 4% now is the new norm. 4% intraday, 5% intraday swings are the 1% and 0.5% daily swings back here. It's just the new norm, so don't read too much into it unless something technically significant happens. What does that mean? Well, recovery of that. You get into that, there's a gap to be backfilled. The top of the gap is natural resistance, as is that 200-day, especially on a daily closing basis. So to reiterate, the whole basis for setting the stop there, I wanted to give it enough room, and I may change that to, if I didn't say it already on the post, I may change that to a stop on a daily close above that level, because if we ran at it, could pop it intraday and then fail back down below and close back below the 200-day EMA. But we'll leave it at whatever I did right now. If it's a single move, it should be enough above there. Should be. And there's also some resistance around that level. So that's it. And as I always say, these are suggestions. If you want to cover, if you did cover today, fine. Take the quick 8% gain from our short trade, where we entered roughly, and move on, wait for the next objective entry. But again, this is technical damage. And I'll just end it here. We gapped down, cleared both the 200-day SMA and EMA. However, the big test now is, this T1 target was not a random number. I didn't just pick a number, especially right below. If you think about it that way, logically, why would I place a target just below support? Because support once broken, that's TA11. You want to short it. That opens a move to more downside. However, I call this is a benefit of the doubt support. When I'm trading, whether it's trend lines or moving averages, price resistance or support, if I have a support level that's broken, but then just below that is another one, which it was. This is a big level right here. This is QQQ. Had the line is at the actual resistance. I have it 194.90. So we'll call that 195. I always set my short buy to cover orders on shorts a little bit above the actual support level. I expect a reaction. So that was a big level. 1, 2, 3 attempts for QQQ to get through that level. It couldn't do it, pulled back each time, but this time it powered through and cleared it. And so this is the first test of that level. This is a big level. And, the markets could hold this, defend this level, and then regain those 200 days. Or we could just consolidate here for a little bit. Anything is possible. I don't know. All I can tell you is this is support. And if taken out, if the Qs, we've reversed, this is a red candle, but we're at the top of it right now. It's red because we're down on the day. So I think the big thing is from here, and hopefully we'll get some resolution later today, and maybe if not tomorrow. Take out today's lows, especially a solid close below that. That's bearish because then this support has given way. This 195 support has broken, and that opens the door down to the next targets that I gave you. These are all potential targets for what may morph into a swing trade. Otherwise, the market so far has made an impressive recovery off the lows. I'm not going to dismiss a 4% recovery rally, especially with the technicals I'm about to show you. So let's get to that. Before we do, everyone always asks, SPY, what's the SPY look like? Remember, the SPY had already taken out the 200, both its 200-day SMA and EMA last week. They took it out on that initial leg down, came up, essentially back tested and failed there, and so far nothing but a rejection off those levels. SPY does have some support here. I'll make mention about 273.57, which is right about today's lows. If you look closely, there's that candle. Why do I have that line there? Well, it's this reaction low from back back here, early June 2019, and another reaction low right here back in early March 2019, and then a reaction high there as well. So that is support. It's not the most solid. It's not as solid as that QQQ support, but the fact QQQ is at support and SPY is also at support says, hey, if the buyers are going to step in, this is where they should. It's the way it works. And if this goes, then boom, likely we go down to the next support level. I don't have them all marked up here right now, but I'll tell you, give or take right about here. You can see a lot of support, a lot of reactions there, another reaction there and there. So that'd be about, opens the door to about 258.55 on SPY if that goes. Otherwise, there's a big old gap overhead to be backfilled. And it can work its way backwards now. Let's look at the 60-minute charts because that's really what's pretty compelling to me right now. All right, so we had a move down, big gap down today, but so far we have the potential right now for the first time in a while some very clean and clear bullish divergence. What I like to see during a bullish trend to go short during a bullish trend for a pullback or correction is divergence on at least the 60-minute time frame. That's my go-to swing trading time frame. You can see all here we were in a very, very strong uptrend. So you might look and say, well, these are pullbacks, Randy, but they weren't much. But they were the biggest pullbacks in months. And then finally one played out for the big kahuna right there, that last divergent high. And just like I like divergent highs, I like to go long on divergent lows, cover shorts, and get ready at least with a buy signal coming. And when you get a buy signal, you look for these divergent lows like right here, and that's a catalyst for a rally. So this is a nice clean divergent low. Remember, divergences in themselves are not buy signals, but they are an indication of a trend change, an impending trend change, that it's likely. What you look for are buy signals, and that can come in many forms. Bullish reversal candlestick patterns, breaks of support, resistance. So on SPY, pretty much, I know I have a lot of lines on this chart. Ignore everything overhead. You have this reaction low from that February 28th, Friday, February 28th, right there. That's potential resistance. You have a big old gap right here. And the top of the gap would be your next logical resistance on SPY right there, right around, give or take, 290.27. And then you can see other levels. But the more we go up from here, the more likely we are to have this divergence confirmed if the PPO can make a bullish crossover, meaning this blue line, the PPO line, crosses up above the white line, which is a signal line. That will then put in a higher low on the indicators, RSI down here, PPO, with prices making a lower low, and that could set the stage for a multi-week, even a multi-month rally. That would be a pretty big and clear divergent low. Same thing we have in QQQ right now. Potential unconfirmed, pending a bullish crossover there. So far, nice reversal off the lows. We're trying to get in that gap. It's been a little bull flagging action going on here. If you look at today's price action, let's turn off. I'll leave that on. This is today right here. This is all the pre-market session. But if you look at this, you have this potential, thrust up this morning off the lows after, they shut the futures. They halted trading when the trading circuit breakers were hit, kind of flagged here a little bit, and now we're moving up. So there's a catalyst to maybe backfill that gap if this bull flag on this 5-minute chart plays out here. And one of the things you want to look for in a bull flag is impulsive breakout. So far, pretty impulsive. Everything today has been impulsive. So I wanted to point that out. All right, so we have those potential, flaggish actions. Everything's kind of choppy. I don't want to it's easy to see flags throughout here. I don't make too much of it, but you do, again, it's the nature of this move. Impulsive so far, period of consolidation since the open. Remember, the open was right here. And now we're moving up, and we took out that recent high. And there's a big old gap that we've entered now. We've entered today's gap. So there is, I have to point that out, and that's certainly the potential. The fundamental picture continues to deteriorate with, with the everything going on with the coronavirus and the impact it's having on the economy, and will continue to have if people stop traveling and and doing other stuff. All right, let's okay, so I showed you QQQ, SPY 60-minute charts. Let's look at the futures real quick. And then I'll get to one other thing and try to get this video out to you guys. Hopefully it'll end up being a lot shorter than the last one. All right, where are my NQ? All right, NQ, NASDAQ 100. Probably as of now, I'm not going to say it's more important than the S&P 500. That certainly isn't true, but it's the one I'm focused on, and the technicals are pretty clear. So here's a bigger picture. We're looking at a yearly chart. This is 2 years. If I don't make mentions, usually up in the upper left-hand corner. I know I'm doing a video, and sometime there it is. If I had it cut off, you can see it there. So we're looking at a 2-year chart with daily candlesticks right here. And this is that same level on QQQ I showed you. All right, so it's not coincidence. They track QQQ and NQ, both track the NASDAQ 100. You have a confluence of support here. You have uptrend line support, which was taken out today on the gap down, but then recovered, since recovered. That's bullish. I cannot spin that as anything but bullish in the fact. Now we're down 4% on the futures, so don't get me wrong. The move down today, especially after this period of consolidation, a lot happened today, was bullish overall. But when you break support only to have it recovered, as long as you're above that line, you got to give it to the bulls because that's a recovery. But let me caution you, the day is still very young. A 4% reversal on a down day like today can be reversed again, and we can plunge down. Anything can happen. So but by the time I'm doing this video, it's not even noon yet, and to close today, the charts probably can and probably will change. So what would be bearish? Obviously, a reversal today, foil those flags, fail to backfill the gaps, or even if you backfilled them, went all the way up and then fell back down. Close below that line, but you also have a confluence of support, a cluster of support. You have a support zone that runs from about 79.98, we'll call it 8,000, up to about 80.80 right there. 80.78 is the number. Those two lines plus trend line support. So that's why I say if we jog down again and close anywhere near today's lows, especially below it, that puts this support in the rearview mirror, and that opens the door for more selling. Otherwise, right now, we've had a sharp correction, a big drop off the highs, and so far, a successful test of support. But again, the day is young, and this is I'm not showing you the 200 days and the other levels that I showed you on QQQ, so there is plenty of overhead resistance. And we'll just have to see how today ends, but I wanted to make mention, the markets have a chance here of rallying in the coming days to weeks if they can hold this level, put in those bullish divergences on the 60-minute charts, and backfill today's gaps and move up, and let's say they take out those 200-day and EMA and SMA and overhead resistance levels, you could be looking at a rally here. So that's something you need to be prepared for, and you decide if you're still short the Qs, whether you want to cover, where you want to cover, or at the very least, like I said, there's no reason that I can think of to let that trade get away from you and turn in, from a profitable trade that it still is, still very much profitable, to a losing trade. In other words, at bare minimum, you want to use some wide stops, try to swing for the fences here. Should we get a kickback rally that lasts a day, couple days, and then gets sold into with another big leg down, then you could set a stop at break even, so you're not losing anything, and you're giving plenty of room if this is just going to be if this is just an oversold short covering rally. I have no doubt Washington's doing whatever they can to prop this market up, but I'm a firm believer that eventually the market's going to go where the market needs to go based on fundamentals and other forces, in their the technicals part of that. Okay, so we looked at the daily chart, and that's big level. So again, anything much down, even close to today's lows, that's probably boom, another leg down, more to come. Bad news from the market. However, from a technical perspective, again, I would be remiss not to point out this, they're clean divergences. What I mean by that, clean separation here. There's a lower peak low in the PPO down there, and another reaction low that's a higher low. That's what we call positive divergence, these indicators. And here's the RSI making higher lows. Price is making a distinct lower low with a big reversal stick off there. Again, back out what you think coronavirus has done or will do to the economy. This is from the technicals so far. This is setting the stage for potential rally. So I'm giving you what's in the charts now. What could foil? Well, anything could foil that. Selling could step in. Divergences could be burned out, and also, realize that we're still in an intermediate term downtrend off these highs. We're not, we're still below that previous. Well, now we're taking back that previous low. But what happens is divergences tend to play out, fail more, or not play out during a larger downtrend. So what will that? When will we know that? Look, we're not far off there. If we take another leg down, the PPO is going to come in here and undercut that previous low, and then you no longer have the divergence there on the 60 minutes. So those are things to look for. But again, right now, we're seeing this recovery rally off the lows, and it continues to build as I do this video. Now we're up, almost 5%, 4.77, and still going. Those flags are playing out, and we're moving up impulsively so far. So you have to recognize that for what it is. And again, you can see some resistance levels here on NQ. ES, the S&P 500 futures, almost same technicals, and not a reason to go over that. Other than here's that previous reaction low. We haven't taken that out in ES yet. We took it out just now in NQ, but there it is. And I'm talking about the Friday, the low from February 28th, I think it is Friday there. And you can see some potential downtrend lines. Nothing significant, but that's probably the one to watch right there. So, the market can still do this. The point is, it has a lot of overhead resistance now to contend with on the way up. And I'm showing you what's developing, bullish developments on the 60-minute charts, but the daily charts take precedence over the 60-minute charts. It's really simple. I might confuse you with analysis. You have 60-minute, you can go down 30-minute charts, 15-minute charts. You can go to any time frame you want. But the key is, the longer the time frame, the more significant the technical developments. That's how it works for me. I put a higher weighting on what's going on the daily charts than on these. If we broke support on the weekly chart, and we're below a former support, now resistance level, to me that has a higher weighting than what's going on the daily charts. And so right now, to loop back to where I started the video, so it doesn't sound like double speak, because these are things to watch for. We're still gap down below those key moving averages, and we're flirting with that support, although right now at this point in time we've recovered it. So price support, I'm not going to say, well, sometimes it depends on the support level that I might give it a higher weighting than a moving average, but they're both worth watching. And so far, most importantly, like I always say, give it the benefit of the doubt. You have the moving averages there, but then you had price support, a good price support, which again to me was important enough to set the target on that short trade not on another run down to those levels, because that's where I expected the first decent reaction, and that's what we've had so far with that 5% reversal in QQQ. So to just wrap this up, at least get off the markets here, bearish if we take another jog down and take out today's lows, especially a close anywhere down at or below today's lows, bearish. And the more we rise from here, the more bullish that is. Next resistance being the top of the gap, which also comes in around the 200-day. If we take that out, then it just continues to firm up the case for more upside, because that divergent low is in, and a lot of resistance levels have been taken back. Means the sellers or the buyers have stepped back into the market, and they're overwhelming sellers. But I still favor, to be very clear, I wouldn't have changed the target. I still favor more downside, and prefer on swing positions for the time being to ride those out and see how the day goes. The other thing that I covered in the other video this morning, I am watching very closely and considering an official short trade on corporate bonds. I don't think I've ever added LQD. I'm pretty certain I've never added that as an official trade on the site. It is a corporate bond ETF, and what happens there is, let me figure out how to phrase this. I've covered this in the past. In fact, I've written on this and put together, covered it in videos. And the gist of it is, in recent years, due and largely, well, actually almost all in part, to the excessive easy money policies of the Fed, super low interest rates, quantitative easing, there's been a tremendous issuance of debt. Now the problem is a large part of that debt has been issued in the corporate markets. I'm talking about corporate debt. Of course, there's been a ton of treasury debt at the low end of the investment grade scale rating. Now there's three main agencies, but two of the three use triple B as the lowest credit quality investment grade. Anything below a triple B rating, then you have, above that you have, down below you have double B, and then single B. Above it is here, let me go this way. Above the, triple B, you have A. I'm making a mess here. Just imagine that's an A, and then double A, and then triple A up top. You can't get better than triple A. I'm ran out of space here. And then anything triple B and down is considered junk bond. Anything really, if you go much below that, you get down to C, and then D. D is in default. So anyways, triple B is your where you cross the line. You go from triple B down to double B, and now you're at junk status. I can't draw. This is not a drawing tool. It's only a line tool, but that's JNK, HYG are two ETFs that hold junk bonds. And so what the big deal about that is the fact, if I'm just drawing this out here, you have LQD up here with these corporate investment grade bonds. LQD, if I could do it this way. And so an ETF, and you have a tremendous amount of mutual funds out there that hold investment grade bonds, and you also have some that hold junk bonds as well. Undoubtedly, a lot of you listen to my voice have bond funds in your 401ks, and almost certainly majority of those bonds are in investment grade bonds. That's where almost all 401ks, most of them don't even give you a junk bond ETF. If they have any exposure to below investment grade bonds, it's very little. So there is a tremendous amount of money in the corporate bond world. And the problem now that I foresee, potential problem, is in recent years a huge amount, an unprecedented amount has been issued right at the low end of that investment grade. So here's what happens. Okay, I don't care who you are, but I think you'd find it very, very hard, almost impossible to argue that the coronavirus, the impact that it's had so far and probably will continue to have on the economy, is anything but negative. You can't spin as positive. So let's just go with the theory here that we may be heading into a recession. Coronavirus could trigger the long overdue recession, or at least a significant downturn in the economy, right? So when that happens, what happens is these corporations have their credit quality downgraded. Business suffers. Think of all the hospitality, transportation. Think of what's happened to airline stocks, hotels, things like this, and even retail stores. A lot of things. Restaurants. It all has a ripple effect. So you see downgrades, and now so what's the big deal? Well, what happens is mutual funds. If you have in your 401k your Schwab investment grade bond fund, by prospectus. A prospectus governs what that fund manager can and cannot do. That fund manager may love gold. He may see the dark clouds on the horizon, and his money or her money is in gold, or a good part of it. But guess what? By perspective, he or she is tasked to manage an investment grade bond fund that says they can only hold investment grade bonds. So when a large part of their holdings are downgraded to junk status, just one notch down. Remember, there goes from AAA, and there's little plus and minuses in between. There's a lot of variations in that scale. But when you cross this threshold from investment grade to below investment grade, aka junk status, they have to be sold. And there's so many of those. So what happens is, as these fund managers and institutions and pension funds and hedge funds and all start selling this, you have a market of a lot more sellers with not matched up with enough buyers. The junk bond market is not nearly as big. They cannot absorb all that. So you're going to have selling pressure, and that leads to a potential crash or very sharp drop in the investment grade market. And see, most people aren't seeing that. There's been a huge run up. Let me show you something here. Remember, the stock market remember we peaked back here a couple weeks ago. Everyone's flocked into investment grade bonds thinking, oh, these are investment grades. These are good companies. Government bonds are investment grade, for that matter. Treasuries are AAA rated. But, guess what? The federal government is always going to pay off their bonds, and it's easy because even if they ran out of money, no problem. print money. So, they have tax revenues and they can just print money to pay off their debt. So treasury bonds kind of fall in the category. They're always going to be investment grade. But these corporate bonds, that can change. So I think people have erroneously or false. Well, you can see it now with this big drop today. We had a doji candlestick on Friday, gap down today. That's bearish technical action. And as I showed you here, we're just flirting with right now this major uptrend line support. You have negative divergence right here, bearish divergence leading into Friday's high, and we have this large bearish rising wedge pattern. So I'm going to see which way the market breaks today. Like I said, there is that potential for a rally with that divergence on the 60-minute charts. If the stock market rallies, it's probably going to give a little reprieve to the corporate bonds here. It could. And I want to show you the price targets in case I don't make it official today and some of you want to take a starter position. I have targets here. Minimum target's going to be here about 124.70. Set a little bit above that 124.52 support level. Potential second target around 121.82. Couple notes, if you short bonds, corporate bond fund like LQD, you are responsible for the dividend. These bonds pay interest, and the interest is collected by the ETF and passed along to shareholders as a monthly dividend payment, which is technically they're giving you the interest on the bonds, but it's called a dividend when it comes out of a ETF. Just technicality there for you. Anywho, so you have that, but the interest on investment grade corporate bonds is so small that I'm looking for a drop of at least 6% or so down to that first target. Now that's about from where we're at now it's about 6%, 5% even, maybe 5%. Yeah, 5% or so. But the thing about bonds are they're much less volatile than the stock market. So you can take, in my opinion, I will take a double-sized position, oversized position, twice of what I might normally take in, let's say, shorting or going long SPY or even QQQ, because the stop on this one probably be somewhere right around here, maybe 2% or so, and the potential for a lot more downside, especially when I look at this weekly chart. I see, corporate bonds. This was the Great Recession back here, 2008. They bottomed. They've been moving up. Throughout most of the bull market, they traded in this range right here. You can see a big trading range from high to low. Wash, rinse, repeat, buy, sell, trade, bounce in the range. And they finally had a breakout here. So you're like, oh, breakout, that's bullish, Randy. It is on face value, but breakouts that occur with negative divergences and overbought have a much higher rate of failure. So my expectation is that in the coming weeks to months, LQD is going to break down, come down here to about that top of that range, test it about 124.50, may even pass right on through there, but probably have a reaction. From the highs, it's going to be a drop of about 7%, and I think it would happen in just a matter of weeks, possibly even days, if things get ugly here soon, which would far negate any dividend. Remember, the interest of I have to look up the dividend on this. It's probably less than 3% dividend yield on this thing is my guess, and that's an annual dividend. If you make 7% in 3 months, 2 months, or even 3 weeks, the dividend's almost negligible. It almost doesn't even come into play there. And then I think we'll probably break and go down here to the bottom of the range, if that, and maybe more, if that bubble explodes, because again, it is a bubble, I think, of low grade, triple B debt issuance. And again, to me, it's just about trading, getting in front of a rush for the exits, a potential rush for the exits. And at the end of the day, I like to confirm everything. I've talked about this for a long time, but I haven't put this on as a short trade. I haven't shorted treasury bonds or corporate bonds because there wasn't a reason to. Stock market was going up, everything was fine. Bubbles can build for a long time before they pop. But now we have a technical catalyst. There was the uptrend line. It broke down here after the breakout, high level back test, and now we have a minor trend line, which is the same one right here that I showed you on the daily chart, and that will be an objective entry once that breaks. And again, it's a matter of right now just seeing what happens with the market today. I suspect they're making this rally look pretty good, squeezing out some shorts, probably sucking in some bargain hunter longs. I think we'll probably dump at the end of the day, and let's see where we go. Really, I think that makes sense before adding any positioning, before trying to If you want to go long because you see that potential divergent low that I pointed out, and the fact that QQQ has held support, I'm going to say that it is certainly objective. I can make an objective case to go long, because when again we hit support, we hit that target level I had, and the market so far has had an impulsive reversal off support. There it is. So one could go long and set a stop, a trailing stop, and just let it ride. And maybe the worst is over. That's not my preference. That's not what I'm doing right now. I'm looking to, and I have already started to nibble away, adding some short onto this bounce, because I do think it'll be likely faded by the close. But again, I'll reassess things later today. All right. The video didn't quite go 40 minutes, but close, 35 minutes. I'm going to wrap it up here. Again, a lot of stuff, but these are the things I'm focusing on. These levels on the stock market, that potential short trade idea in the corporate bond ETF. Again, unusual for me to, even short bonds, period. And then why you might think one of the strongest looking bond groups right now. You might say, Randy, why don't you short junk bonds? They're breaking down and they go down with the stock market. They trade in line almost perfectly with the stock market because of their, that's what junk bonds do, because they're more susceptible to the credit cycle, and they trade more on that than they do on what they're paying in yields. Whereas other bonds, like investment grade bonds, treasuries, and high investment grade corporates, tend to trade more so on interest rate sensitivity. Whereas again, these trade on the economic expectations. So junk bonds are trading in line with the stock market, and that train's left the station. I think I mentioned it before. It was certainly was really here when it broke that 105.65 level. But again, you're coming up on support. You have a reaction low on JNK. I just see more meat on the bone, and I like the trades no one else sees coming. Those are where you can get some really nice gains. And so again, that's why I'm eyeing the corporate bond market, because I think that could be, like I said, one of the bubbles that others have talked about it, but we just need that catalyst. And that's how the markets work. It goes up, up, up until everyone decides, boom, the tide has changed. All right, guys, got to wrap it up here, get it out to you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.